Think about the number of times you have looked at a cryptocurrency price chart and say to yourself, it looks like the market is going to go up or down, but you did nothing except watch the market move. And what you thought was going to happen actually happened while you anguish over all the money you could have made. There is a magic big difference between predicting that something will happen in the crypto market while thinking about all the money you could make and the reality of you actually getting yourself into a trade or out of a trade. Hi, welcome to this introduction to cryptocurrency technical analysis video. In this video, you will get to understand why technical analysis actually works and the three basic aspects of technical analysis that crypto traders and investors use to enter or exit a trade. They are essentially two methods of investing or speculating in the cryptocurrency market. You can use either the external or fundamental information, such as the profit outlook of an individual cryptocurrency, the overall market capitalization, or the potential supply and demand of a particular coin. Or you can use strictly internal technical information, which ignores all the fundamentals and focuses instead upon the actual pattern in the price movement, the actual buying and selling in the marketplace. The major secrets hidden in great old stories of great veterinarian traders like J.C. Livermore in the late 1970s or early 1980s has everything to do with technical analysis. Because here we hear of a 14-year-old boy, J.C. Livermore, who at this early age already understood the amazing power of numbers and the repeated pattern these numbers form while he was still working as a clerk boy, struggling to post the numbers on the board. Just by simply observing and noting down repeated numbers and patterns over time, J.C. Livermore came to discover the ability to use these repeated numbers and patterns to predict accurately the future of all the bucket shop prices, and he almost drove them out of business, leading to all the bucket shop banning him from coming into the bucket shop. Later went on to the Wall Street to make millions from these patterns. The basic forces that drove prices up and down in previous generations are still at work today. A finite number of traders participate in the market on a given day, week, or month. Many of these traders do the same land of things over and over again in their quest to make money. All markets, both then and now, are all auctions, and all auctions are governed by same general principle of supply and demand, no matter the technology involved. The prices of any cryptocurrency or stock or forex or commodity today, just like in the past, still mirrors the investors and their collective expectations of the future and the emotions of hope, fear, and greed. In other words, individuals develop behavior pattern, and a group of individuals interacting with one another on a consistent basis form collective behavior pattern. These behavior patterns are still observable and quantifiable today, as they still repeat themselves with statistically reliability. It is the ability of technical analysis to identify and predict signs of this future perception. If you have been trading before now, I am assuming you already know there can also be a big gap between what you understand about the market and your ability to transform that knowledge or information into consistently making profit or even a steadily rising equity curve. Instead, you find yourself battling to even keep any profit you made on a daily basis. What then is technical analysis and what makes it so powerful? Technical analysis is the method used by investors to organize collective behaviors into identifiable patterns that can give a clear indication of when there is a greater opportunity or probability of one thing happening over another. The market is made up of a collective mind of individuals constantly trying to make a decision between buy or sell. So the power of technical analysis allows you as an individual trader to get into the collective mind of the market, to anticipate what is likely to happen next based on the kind of patterns the market generates at some previous moment. This particular superpower technical analysis gives trader makes technical analysis far more superior to a purely fundamental approach of fundamental analysis. The cryptocurrency market is known to be very volatile when compared to past markets when J.C. Livermore and the rest were in play. But because cryptocurrencies are used to settle transactions between buyers and sellers, in other words, supply and demand is still in play, thereby making technical analysis a deadly weapon in the hands of the right man. Technical analysis turns turns the market into an endless stream of opportunities to enrich oneself. They are people who have mastered the act of trading and have successfully closed the gap between the possibility available in the crypto market and their bottom line performance. But as you might expect, these winners are relatively few in number compared with the numbers of traders who experience varying degrees of frustration, struggling and wondering why they cannot create consistent success that they desperately deserve. Before you decide to take the red pill I am offering you here to unleash the hidden superpowers of technical analysis in cryptocurrency trading, to end your current endless cycles of losing money left and right and getting decimated by choppy, volatile, unpredicted market like the crypto market, I must warn you of the 3 known deadly killers of crypto traders' ambition that are desperately sending careless crypto traders to early grave of bankruptcy to never return to the market. Like a time bomb, these 3 fatal cardinal errors of investing kills faster than a grenade and must be avoided at all costs. So these 3 errors committed by these traders include: 1. They overtrade. Some traders feel like you must trade all the time to make money. These traders are too anxious to always do something, and they do it with too many position size trades. They make mistakes of overexposing themselves to the market and thereby increasing the chances of giving back to the market any profit they have made out of greed from over trading. If you must trade consistently, then if you remember nothing else from this video, do remember this: trade in modest amount so that you can stay cool, unworried and unbothered, and at the same time unemotional about any particular trade. Second biggest mistake, they trade without simple set of procedure. That is to say, they have no trading plan, or if they do have a trading plan, they fail to follow them. They tend to easily get carried away by fear, greed and hope, forgetting to implement the said trading plan and end up constantly experiencing the same punishment from the deadly unforgiving market. Anyone who puts on a trade can claim to be a trader, but when you compare the characteristics of a handful of consistently winners with the characteristics of most other traders, you will find they are also as different as night and day. The only thing about trading that is consistent with this group is emotional pain. Yes, they certainly do have moments of elevation, but it is not an exaggeration to say that most of the time they are in state of fear, anger, frustration, anxiety, disappointment, betrayal and regret. But what then is the magic powers behind consistently profitable traders? Are the consistent winners just plain smarter than anyone else? Do they possess inherent personality characteristics that makes it easier for them to deal with the intense pressure of trading? Do they work harder? Are they better analysts? Or do they have access to better trading system? These are probably the questions running through your mind when you find yourself losing. The answer to the above questions will be answered in due time later in the mental analysis video, but just know that the largest group of consistent losers is made up of primarily of smart people like lawyers, the doctors, engineers, scientists, CEOs, wealthy retirees and entrepreneurs. So think about it. Furthermore, also you will get to find out that most of the industry best market analysts are the worst traders you can imagine, because trading and market analysis are 2 separate different skill sets required to become a successful trader in this market. Trading, unlike market analysis, requires strong mental control, as traders are constantly faced on daily basis multiple decisions they must make. You can predict the market successfully and still struggle to make any tangible profit at the end of the day with your trades. Your technical analysis is supposed to be a guide while you use your mental analysis to handle the trade position. The strategy and trading system you will learn in this crypto trading bootcamp are more like building blocks for you to build your system on. You will be provided with trading rules, also known as trading plan, that you can follow easily without ambiguity. Why during your training, we seriously recommend starting your learning journey with a maximum capital of $100 or less, at least $10, until you have proved to yourself that your confidence and emotion is strong enough to handle a bigger account. above $100. Why do I recommend this? Because we understand that it's going to take time for you to develop your mental analysis. Why don't I recommend paper trading? The answer is simple. Paper trading fails to teach new traders discipline, control, and stability, which is purely mental and emotional aspect of trading, which can only be obtained from real experience. To build emotional control, a real true feeling of volatility and loss must be experienced firsthand by the trader, which in turn will force the trader to sharpen the necessary mental capabilities needed by the mind to build the right emotional response to handle volatility and losses in the crypto market. If you can build and grow $100 to $1,000, I know it's not easy, I don't care how long it's going to take you, then you are ready to trade a bigger account with confidence. But if you fail at achieving this goal to turn $100 to $1,000, it only means you are not ready to handle a big account successfully, and you're likely to lose that account the same way you lose the $100 account. Also, I would like you to think of every money you have lost or is going to lose as a school fees paid to the market for the experience and lesson during your training. Remember, each trade is like a building block that will shape your trading life. This is why starting with a small amount as $100 or less will keep that school fees less painful during your learning process. Remember, every mistake you make will be punished accordingly by a market that never sleeps or slumbers and never forgives. So remember that when you are breaking your own trading rule. Like Mark Douglas said in his book Trading in the Zone, if going to the moon represents consistent success as a trader, we can say that getting to the moon is possible. The journey is extremely difficult and only a handful of people have made it. Trading successfully feels the same way on any given day, week, or month. The market makes available vast amount of money to anyone who has the capacity to put on a trade. Since the markets are in constant motions, this money are always constantly flowing, which makes the possibility for success greatly magnified and seemingly within your grasp perspective. Third major critical errors these traders commit, they are constantly getting overly influenced by what they hear or see outside of their own technical analysis. Even the most professional traders can fall victim of these critical errors. It's only natural as we humans are social animals. But to become successful, you must learn to act independently, more like a loner, because if you listen to someone else, he may get you in at the right time, but will he be able to tell you when to get out? This is why those who are dependent on trading signals are constantly going in cycles. Here at Machiavelli Traders, our goal remains to build independent, consistently profitable traders. To a Machiavelli trader, trading signals is a sin and must be avoided. Instead, he or she depends on themselves to make the right decision and trust their own edge. This is the reason why we never offer trading signals in our VIP group. Instead, you will get to trade live with me, Bitcoin Gorilla, as an independent trader you are, meaning I will give you hints of my activities and response to the market conditions at any given situation, as I do update students regularly to encourage them on their trading journey. By them seeing my experience on the journey, they use it as a way to build confidence. But be warned that every trader is expected to act independently, despite what you hear from me in the group. A Machiavelli trader functions and operates like a spider. The spider does not need to feed every day. Instead, it is content to wait until a morsel comes its way. The spider is patient and secured in the knowledge that it has taken the steps necessary for its survival. Its own carefully crafted spider web transmits to it all sorts of information, but it knows for sure how to identify the first signals, like the wind vibrating its web, a drop of rain, or a leaf, from the real food that he awaits. But how does the spider get to know all this, you might ask? Because the spider has carefully constructed its web by its own self, so no one else can build the web for it. As a result, the configuration of its web is as uniquely as its own fingerprint. But most importantly, the spider is patient. Machiavelli traders are patient. You must wait until you see convergence of most, or if not all, the signs and confirmation before you act. But when these signs and confirmation signals are affirmed, you must proceed aggressively without hesitation. You must be willing to go short in any market that is trending down, or go long in any market that is trending up, without hesitation hesitating to reverse your position when the market reverses. These are the 3 basic needs that technical analysis provide a crypto trader and how to use them. The 3 basic needs include trade entry rules, stop loss rules, trade target rules. But how do you use them? So I'm going to start by breaking these 3 rules down. Trade entry rules. In trending markets, pattern formation confirmation are critical for trading success. Most of the reversal patterns you will see in the market need a price confirmation from price reversal zone. An important technique is to find a reversal candlestick. The wider the better, and then entering on 1 or 2 candles above the candlestick's high for a long, you can say buy, or below the candlestick's low for a short, or you can say sell. For example, let's say I see a long or buy setup opportunity in a pattern after a trend line breakout. I initiate a long trade only after 1 or 2 candlesticks above that breakout candlestick's high. The 1 or 2 candlesticks act as a confirmation to the setup or a confirmation signal. Similarly, if I see a short setup opportunity after a trend line breakdown, I only initiate a short trade only at 1 or 2 candles below the breakdown candle low. These entries are only valid for 3 to 5 bars. Beyond that, the setup may not materialize and should be avoided. Stop loss rule. Most patterns are only traded after a clear confirmation signals. The success of pattern structure is dependent on the market conditions. This tells you that a pattern failure may occur when the pattern setup is not valid due to market price action reversal. There are many times that the stop loss are set just below a critical trend line support and resistance level, or at a major swing high or swing low, but never put a stop loss on a trend line, because chances are high you will get kicked out and the move will continue. Once the price breaches any of these levels in weaker or stronger market, the pattern structure will fail. The stop loss is set below the trend lines to cut losses short, as most times the failure can lead to bigger loss of the trade. This is done to cut losses short, as most times the failure can lead to a bigger loss if the trade is not exited after an important level is broken, especially in a high volatile market like the crypto market. Traders also implement what is known as trailing stop. Now, in trailing stop, this is done by following the trade up with the stop loss by moving the stop constantly after a new support or resistance level has been broken and tested successfully. By doing so, they lock their profit, but this can only be done in a winning trade. Trade target rules. Managing stop losses and targets is an art form because every pattern has its own target and stops. Each trading pattern will be studied in a later video, and these stops and targets will be elaborated in each video. But for now, I must tell you this: never enter any cryptocurrency trade just because of some price level like support, moving average, or Fibonacci levels alone. Always wait for a confirmation before you enter such trade, but always never hesitate to exit a trade because of some important price levels to protect your position. But I will say this here, that when dealing with patterns like channel trading, the targets are the range of the channel or depth of the pattern, such as head and shoulder or swing high and swing lows, prior to the pattern formation.
It's only worth it if you work for it. It's only worth it if you work for it. I won't stop till they hear me now. I won't stop till I wear the crown.